Investment number one that benefited during the 2020 pandemic, the 2008 crash, and the 2000 dot-com bubble bursting was gold. And yes, I'll go over a couple ETFs to give you exposure to gold in just a second, but let's go over some numbers first. In the year 2020, we saw the S&P 500 fall by 30-some% in the middle of the year, and then we saw the stock market rally. Over the course of the year 2020, the S&P 500, which is an index that measured the stock market, it's a group of the 500 largest companies in the stock market, this went up by around 18%. While at the same time gold prices in 2020 grew by around 25% over the same year. In the year 2008, when the housing bubble burst, we saw the S&P 500 fall by around 35%, while gold prices went up by around 5%. When the dot-com bubble burst in the year 2000, I'm lumping in the years 2000 to 2002 because it really took the year 2000, 2001, and 2002 to see the full market downturn. We saw the S&P 500 fall by around 37%. We saw the NASDAQ, which was very tech-heavy, very dot-com heavy. It's another index that measures the stock market. This fell by around 70%, while gold prices went up by around 22%. Now, if you wanted to get exposure to gold, you can invest in a gold ETF, something like GLD or IAU. These are two different ETFs that you can buy and sell on pretty much any brokerage on the stock market that will give you exposure to gold. But remember, you're just buying a paper contract that says you have ownership or exposure to gold. You don't actually own the physical gold. Another alternative is to actually buy the physical gold. That's something that I personally do. I've been buying gold since well before the pandemic, but I do want to express some concerns that I have about gold as well. Gold prices have been booming a lot since the pandemic and a lot in 2025. And a lot of people who don't even understand how to invest in gold have been dumping money into gold because they believe that gold prices are going to continue to go up because of how fast it has gone up. But there are concerns with that because, well, when people are betting on gold, they're betting against the dollar. Because remember, gold is generally a hedge. And when people are concerned about the dollar, when they're concerned about inflation, when they're concerned about the United States economy, that's generally when they buy physical gold. So when you hear people buying gold because, well, they believe it's a great investment, that generally creates some concerns because, well, maybe there's something seriously wrong about the dollar, or it could be creating a bubble around gold as well. What we've been seeing happen in 2025 is that gold prices have been outpacing stocks. And the reason why that's so unique is because when you invest in a stock like, say, Amazon or Apple or Nvidia, these companies are working to produce a profit. They have employees that are working to create a better product. So they're working to produce value, versus your gold is just sitting there looking back at you. Doesn't actually produce any value. So it's a type of insurance, a type of hedge against worst case scenario situations, and gold prices have been outpacing stocks, which means yes, investors have some serious concerns, and it's something you want to pay attention to. Now, the other thing that I want you to understand about gold is that gold prices don't always go up. Gold prices generally go up when people are concerned about the dollar. Take a look at this chart. You can see that gold prices really boomed after the 2008 crash because people were concerned about the dollar when quantitative easing was happening. That was when the government was passing all these stimulus programs to fund and stimulate the economy, and people were concerned about hyperinflation. So gold prices were booming between 2008 to 2012. But in 2012, when people realized that the economy was recovering, gold prices crashed as the economy recovered and markets went higher, and gold prices did not hit a new high after 2012 until the year 2020, when of course the pandemic hit, the recession hit, and worries about inflation and hyperinflation started again. And now gold prices have been breaking new record highs ever since because people are still concerned about the dollar, they're concerned about inflation, they're concerned about the economy. But if those concerns go away, well, gold prices could fall again. So from history, we can see that gold prices have generally benefited when a recession happens. But today we're not in a recession and gold prices are breaking record highs, which has some people concerned. Does this mean something's really wrong in the economy or is something wrong in the gold market? And the other thing that I want to talk about before I get into number two has to do with Bitcoin, because a lot of people say that Bitcoin is the digital gold. Is Bitcoin an alternative to gold? And yes, Bitcoin has provided some amazing returns over the last number of years, but it hasn't been around the same way as gold. Now let's take a look at some numbers of what happens during volatile periods. Bitcoin was not around for the 2000 dot-com bubble bursting, so we can't talk about it here. Bitcoin wasn't around for the 2008 housing market crash, so we can't talk about it here. But Bitcoin was here during the 2020 pandemic, and what we saw is that during this time, Bitcoin prices went up by around 300%. So yes, it beat gold and it definitely beat the stock market. But what we've also seen is that Bitcoin doesn't always move in the same direction as gold, because sometimes when people are worried about inflation, gold goes up, but Bitcoin goes down. For example, in 2025, when gold prices were breaking new record highs in October, Bitcoin prices were falling because people were concerned about technology. In the year 2022, the S&P 500 fell by around 20% because inflation really started to kick in. Gold prices stayed flat, but Bitcoin prices fell by about 60% in the year 2022. So Bitcoin and gold don't always move in the same direction. And what we've seen, at least in the recent years, is that Bitcoin moves closer to tech stocks than it does to gold prices. So is Bitcoin really a digital gold? Well, time will have to tell, but what we've seen right now, especially recently, is that Bitcoin moves more similarly to tech than it does to physical gold. The second asset to generally benefit when markets go down are treasuries. So a treasury is a loan that you make to the United States government. And treasury prices are a little weird because the way that it works is when a lot of people are buying treasuries, treasury prices go up and treasury yields go down. What that means is when you lend money to the United States government, you are buying this asset right here. And this asset has a price, and then this asset is going to pay you with an interest rate. So if a lot of people are buying this treasury right here, the price of this treasury is going to go up because everybody wants to buy it. More demand than supply. Everybody wants to lend their money to the United States government. It becomes more expensive, and then the interest rate that the government pays you goes down. Why? Because you can kind of think of it like if everybody wants to lend money to the United States government, it doesn't have to incentivize you with high interest rates because everybody's already lending money to the government. On the flip side, if people are scared to lend money to the government or they don't want to lend money to the government, so people are not buying treasuries, well, now treasury prices go down. You have more supply than demand. If treasury prices are going down, well, now the government has to incentivize you with higher interest rates to get you to want to lend money to the government. So treasury yields, treasury prices are generally inversed, meaning if a lot of people are buying treasuries, treasury prices go up, yields go down. If people are not buying treasuries, prices go down, yields go up. Now, generally speaking, treasuries are not good investments. They don't generally give good returns because it's considered a risk-free investment. If you lend money to the United States government, you're guaranteed to get paid. Every economics textbook will tell you that the government always pays their bills. Now, if you're more financially savvy, you might say, well, Jaspreet, the value of the dollar will drop if the government doesn't have the money to pay the bills because they're going to have to work with their central bank to print money to pay those bills. And you're right, but they'll still pay the bills. So even if the government doesn't have money to pay you, they can print the money to pay you, which means, yeah, they'll give you the $1,000 you're owed, but the $1,000 is not going to be worth as much. So the government has the ability to pay you, but they just don't guarantee that the value of the money that you're going to make is going to have value. So that's where treasury bonds generally are not good investments. But what we've seen is that when downturns happen, people get scared. They want safer investments. And the United States government historically has been a safe investment. So people generally turn to treasury bonds when markets go down, because we've seen that happen in 2020, 2008, and 2000. So let me just show you. Now, if you wanted to invest in these treasuries, you can go directly to Treasury Direct, which can be a little bit complicated, or you can just do it on the stock market by investing in an ETF that's giving you exposure to these long-term treasuries. So for example, TLT is an ETF that gives you exposure to the 20-year treasury bond, and then you have IEF, which is an ETF that gives you exposure to the 7 to 10-year treasury. So both of these will give you exposure to treasuries, and TLT was around during the 2020 pandemic. It was around during the 2008 pandemic, but it was not around during the 2000 dot-com bubble bursting. So I'll just give you the returns of TLT in 2020 and 2008, and I'll just talk generally about how the treasury market did during the year 2000. That way you can compare it to the other assets. In the year 2020, when markets crashed and rallied by 18% in total, TLT grew by 18% as well. In the year 2008, during the housing market crash, the S&P 500 fell by 35%. Gold rallied by 5%, TLT went up by 28%. And then during the dot-com bubble bursting between the years 2000 to 2002, again, these ETFs were not around at the time, but long-term treasuries went up by around 45%, while the S&P fell by 37%, NASDAQ fell by 70%, and gold rallied by around 22%. Now, again, treasury bonds, generally a horrible investment, but when markets go down, investors want safety, and over the last few decades, we have seen that investors still turn to treasuries when markets are going down, which can create opportunity there. Now, there is concern now that we didn't have as much of during the previous recessions, and that concern is, of course, the health and strength of the United States government, because a lot of people are concerned about the United States dollar, which is one of the reasons why gold prices have been rallying so much in 2025, even though we're not in a recession, and even though inflation has been calmed. But the United States government is still the world's superpower. the United States dollar is still the world's reserve currency, and people still respect the United States' economy. So, yes, there's concerns, but the United States is still number one. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.